You're successful, you make great money, and at some point, if it hasn't happened already, somebody is going to pitch you a tax strategy that sounds too good to be true. Trust me. Maybe it's a colleague at a CLE, maybe it's a guy on LinkedIn with a calendar link, maybe it's a, quote, tax strategist on social media who promises to wipe out your tax bill if you just structure things a certain way. Here's the thing. When something sounds too good to be true, it almost always is. And the cost of getting it wrong isn't just a slap on the wrist. It's back taxes, penalties, audits, maybe even your bar license, and maybe even jail time. Today on the podcast, we're talking about tax fraud and the abusive tax schemes that target high-income law firm owners. The ones the IRS calls the dirty dozen. We'll cover the 5 we see most often, what to do if you've already been pitched one, and the legitimate tax strategies that actually move the needle. Let's get into it.
Welcome to the Lawyer Millionaire Podcast, the show where law firm owners learn to build wealth, scale their firms, and design the life of freedom they deserve. Hosted by Darren Wars, business and wealth advisor for law firm owners and author of The Lawyer Millionaire, this podcast delivers the strategies and inspiration you need to break free from the grind and become the financial success you envision. Let's dive in.
Welcome back to the Lawyer Millionaire Podcast. I'm your host, Darren Wirtz. Before we dive in today, a quick note. Our next book club masterclass is coming up, and we're covering Simple Numbers, Straight Talk, Big Profits by Greg Crabtree. If you want to understand your law firm's financials and what they're actually telling you, how to read your P&L like an owner instead of like a defendant, this session is for you. We'll walk through the key metrics every law firm owner should be tracking, the ones that tell you whether your firm is actually building wealth or just generating revenue. Head to community.lawyermillionaire.com to register. Seats are limited. Okay, now let's talk about tax fraud. First, let's start with a framework. Tax compliance lives on a spectrum. On one end, you have legal tax avoidance. This is everything you're supposed to be doing. Contributing to your 401k, taking the home office deduction you actually qualify for, electing the PTET in your state, bonus depreciation on equipment you actually use. These are written into the code, and Congress put them on purpose. You should be using them. On the other hand, you have tax evasion. Now, tax evasion is where it gets illegal. Underreporting income, faking deductions, hiding money offshore. This is criminal. And in the middle, in the gray zone, is where abusive tax schemes live. Tax fraud. And these are strategies that look legal on paper. They cite real sections of the tax code. They come with binders full of legal opinions. But here's the thing. They twist the law in ways that it was never intended to be used. And if the IRS catches them, and increasingly the IRS does, they get disallowed. So, every year the IRS publishes a list of the top tax schemes targeting taxpayers, and they call it the Dirty Dozen. And every year, law firm owners get caught in the crosshairs. Why you? Why are law firm owners such frequent targets? Well, there are 3 very good reasons why. First of all, you are a high-income earner. Most of our clients make $500,000 or more in personal income. That tax pain is real. You write big checks every April, and you feel them. That makes you motivated to find a way out, and motivated buyers are the easiest to sell to. Secondly, you are a business owner, and there's complexity in your return already. Pass-through entities, multiple K-1s, maybe real estate, maybe a side venture. So when somebody adds more complexity, a captive insurance company, an offshore trust, it doesn't necessarily look out of place. It just looks like the right next step. Third, and this is one that really gets you, you're a lawyer. You're trained to read documents. You're trained to look for what's legal and what's not. And so when a tax strategist hands you a 40-page memorandum citing IRC sections, you read it. And complexity often looks legitimate when you're a sophisticated reader. We call that complexity bias. Add it all up, and you are the perfect target. So, what's the impact? What's actually on the line here? Well, here's the part nobody wants to hear. When the IRS comes calling, you don't get to point your finger at your tax preparer. You don't get to point your finger at the strategist who sold you the scheme. Ultimately, you signed the tax return. You signed it under penalty of perjury. Your name, your signature, your responsibility. And the cost of getting caught is real. So there's a few things that you could be subject to. Number one, back taxes and interest. Every dollar of tax you should have paid, plus interest from the date it was due. Second, accuracy-related penalties. Could be 20% of the underpayment, or could be 40% if there is a substantial valuation misstatement. Third, civil and criminal exposure. In worst cases, this becomes a criminal referral. Tax fraud carries possible jail time. Number four, the audit window stretches. Normally the IRS has 3 years to audit you. However, if they find substantial omission, that goes to 6. And if they find fraud, the window could be unlimited. And finally, professional and reputational risk. Not only could you be in trouble with the IRS, you could be in trouble with the bar. And nobody wants that. So there's a lot at stake here. Now let's talk about the big ones that we see. And we're not going to go through all 12 on the Dirty Dozen list. You can look those up. But among law firm owners, these are the top ones that we see. So I want to warn you about these so you can be on the lookout for them. Number one, micro-captive insurance abuse. A captive insurance company is a real thing. Big companies use them to insure risks that traditional carriers won't cover, or to more effectively cover their risks. The legitimate version is fine, but the abusive version goes like this. A promoter sets up a captive insurance company that you own. Your law firm pays it inflated premiums for risks that may not even exist or are wildly overpriced. You deduct the premiums. Then the captive elects to be taxed only on investment income under Section 831B. The premiums sit there essentially untaxed. Then over time, you can pull the money out at capital gains rates or pass it to your kids. Sounds great. Well, the textbook case is Avrahami versus Commissioner. A family owned 3 jewelry stores in the Phoenix area, and they set up a micro-captive insurance company. Before they set up the captive, they were paying $150,000 a year in insurance. After the captive, they were paying $1.3 million to themselves, to their own captive insurance company. Looks fishy. They were writing coverage for terrorism on jewelry stores in the Phoenix suburbs. The tax court took one look and said, nah, this isn't insurance. They threw out the deductions, and that case has been the template the IRS has used ever since. If you've been pitched a captive that promises to convert ordinary income into capital gains or insure against vague, hard-to-define risks like tsunami insurance for a business in the desert, you should pump the brakes. Number 2, S-Corp salary manipulation. We've talked on this show about the very smart and wise strategy of, as an LLC, electing to be taxed as an S-Corp and being able to split your income into part wages and part distributions. That's a very legitimate strategy. If your firm is doing that, you have to, though, pay yourself a reasonable salary before you take distributions. That's the rule. Salary is subject to payroll tax, distributions are not. The most famous example here is actually a politician. Before John Edwards ran for vice president, he had a one-man personal injury firm. He paid himself $360,000 in salary and took the rest as S-Corp distributions. He saved an estimated $600,000 on payroll taxes over a few years. At his income level, that salary probably was defensible. But the press picked it up during the 2004 campaign, and the strategy got nicknamed the John Edwards loophole. Where this goes wrong is where somebody tells you to pay yourself a very, very low salary on a very large income. And that's what the IRS is looking for. Pay yourself a reasonable salary. Document it. Have evidence that shows why your salary is reasonable. Number 3, this is where it gets fun. Solar and battery farm schemes. Oh, I've seen these around. The pitch is here that you invest in a solar project or battery storage project. You get a giant federal tax credit plus bonus depreciation plus some kind of operating loss all in year 1. The numbers are eye-popping. Sometimes the promoters claim you'll get back more in tax savings than you actually put in. Sounds great, right? Well, the problem is the underlying economics. Oftentimes, these projects don't actually exist. Or the credits are inflated, or the valuations are fabricated. The biggest case here is DC Solar, a guy named Jeff Karpoff. His company manufactured mobile solar generators on trailers out of California. Investors put in money and claimed federal solar tax credits. The catch here, though, is that about 8,500 of the generators didn't actually exist. He was just shuffling the same handful of units around from one investor to another. It was a billion-dollar Ponzi scheme, and the investors he fooled included Berkshire Hathaway's Geico and Progressive Insurance. These were not unsophisticated buyers. Karpoff got 30 years in federal prison. The lesson isn't that all solar deals are scams. The lesson is that even institutional investors can get fooled because the tax credits make them want to believe. Here's the tell. If the headline benefit is tax savings and not the actual economic return of the investment, that's a warning sign. Also, if you're going to get more in tax savings than you actually put in, that should make you pause and ask some very hard questions. Number 4, oil and gas venture abuse. Ooh, I loved seeing all these videos on social media about oil and gas as a great tax strategy. Same idea, different industry. Oil and gas partnerships have real legitimate uses in tax planning. Working interests, intangible drilling costs. For a high-income law firm owner, a properly structured oil and gas investment with real deductions could be a meaningful piece of your tax plan. However, there are certain things to look for. If your only active investment requirement is that you read a PowerPoint once a year and take a trip once a year to Texas, you should be asking some real questions. Also, the abuse comes when promoters package up partnerships that are economically dead on arrival. The whole point of the deal is the deduction, and one of the IRS's biggest tests is economic substance. The problem with many of these is oftentimes the well doesn't produce. The investors lose their money, but hey, they got a tax write-off. Or worse, the wells are fictional. Just last year, August 2025, a guy named Samir Sethi out of Texas was sentenced to over 12 years in federal prison for running an oil and gas joint venture fraud. The investors thought they were buying into producing wells, but they were actually buying fiction. The IRS looks at intent. If the venture was never actually trying to produce oil or gas, the deductions get thrown out. And here's the tell. If an oil and gas pitch leads with the tax deduction instead of the production economics, that's your warning sign. And folks, as I bang the table on this over and over and over again, the point of tax planning is not tax deductions or even tax credits or even minimizing your taxable, tax liability. The whole point of tax planning is to maximize your after-tax wealth. Investing in a losing investment just to get the tax credits to offset other income, those economics don't sound too appealing to me. Number 5, and this is one of my favorites, life insurance. Let's talk about life insurance. Ooh, this grinds my gears. Life insurance is one of the most pitched and most misunderstood. And this isn't classic tax fraud in the way the others are. Nobody's really going to prison, usually, for buying one of these policies, but it is a way that a lot of law firm owners get pitched a, quote, strategy, end quote, that turns out to be a giant insurance policy they didn't frickin' need, with massive commissions baked into the premium and surrender charges that lock them in for a decade. I hate this one. The pitch usually involves a whole life or indexed universal life policy, or what some agents call be your own bank. Oh my God, if I hear that one more time, I swear to God. Or a life insurance retirement plan. First of all, let me just say this. If you buy an insurance policy, you are never your own bank. The insurance company is your bank. You're not taking money out of the insurance policy. You are borrowing against the insurance policy and paying the insurance company for the privilege to do so. Let's just get that clear. So what happens with these is often these policies are presented as a tax advantage retirement vehicle, and they should not ever, ever be sold that way. And I'll explain why. You pay big premiums, the cash value grows tax deferred, and you can take, quote, tax-free retirement income, end quote, later by borrowing against the policy. That is a huge misrepresentation. And it is you can litigate over it. And I'll show you a great example of how this was litigated. Because here's the problem. You're not getting tax-free retirement income. You are borrowing against the policy. Yeah, I could take any kind of loan, and the proceeds from the loan are not taxable. That's not tax-free income. It's not the same thing. And here's what I really hate about these. The premium is usually sized to maximize the agent's commission, not to match how much life insurance your family actually needs. A first-year commission can run 50 to 100% of the first-year premium. By the time you realize it, the cash is growing more slowly than they showed you on the illustration, and you're locked in by surrender charges. That is what I really hate about these. And so here's the example. Pacific Life recently agreed to a $58 million class action settlement in California over their PDX Indexed Universal Life product. The lawsuit alleged Pacific Life marketed it as a tax-free retirement plan to consumers who didn't realize they were buying a high-commission life insurance policy with surrender charges that locked them in for years. This is not some fly-by-night agent. This is one of the largest insurance companies in the country, and they paid $58 million to make the case go away. So that's why I say these should not ever be sold as tax-free retirement plans, because they are not. And because if someone's pitching it to you that way, you have a case. If somebody's leading with, this is the best tax strategy out there, and the product is life insurance, you should ask some big questions. Number one, how much life insurance do I actually need? What is the first-year commission that this person's going to make selling me this policy? What are the surrender charges, and how long do they last? And what is the projected internal rate of return after all costs? And my favorite, what is the guaranteed illustration show? Because when it comes to cash value life insurance policies, the only illustration that matters is the guaranteed illustration. Let me say that again. The only illustration that matters is the guaranteed illustration. If it says non-guaranteed at the top, you better take that with a big grain of salt. Now, let's go a little bit further, because the point of this episode is not all necessarily about don't do tax planning. The point is don't do bad tax planning. Here's the bigger idea and the bigger point. The real goal, as I mentioned, is not to pay less in taxes. The goal is to maximize your after-tax wealth. And those are not necessarily the same thing. Paying less in taxes might mean that you are still poorer than you might have been 5 years from now. Maximizing after-tax wealth is different. So, I want to give you my top 5 or 6? Oh, actually my top 8. I'll give these to you quick. My top 8 biggest tax movers for law firm owners, the ones that we help our law firm owner clients with all the time. Number 1, the 401k and cash balance combination. If you've never heard of a cash balance plan, it's a pension plan, a defined benefit plan that you can pair with a 401k, and it can produce some pretty major tax savings. Number 2 is the PTAT election, the pass-through entity tax, which many states have enacted, which allows you to pay your state and local income taxes at the entity level and bypass the caps, the SALT caps that exist. Number 3 is the S-Corp. That is a big favorite of mine, electing to be taxed as an S-Corp, as an LLC, so that you can split your compensation into part payroll and part distributions. Number 4, bonus depreciation. Number 5, income timing. Looking at the end of the year to see where you are income-wise and how you can shift income or expenses. Number 6, the backdoor Roth, and its cousin, the mega backdoor Roth, which you can do using your 401k plan. Number 7, the Roth conversion, and probably the Roth conversion should be at the top of this list because that's really how you control the timing of your income. And finally, the donor advised fund. Those are some of my favorites. They work really, really well. If you want to learn more about those, I encourage you to connect with me. So, what should you do? Well, get a second set of eyes on your tax return and your tax strategy, especially if you've already been talked into one of the schemes that we covered today. You really, really need to understand the mechanics of what's going on and if what you're engaged in really is legitimate. This is something that we help law firm owners with. Legitimate tax strategy that doesn't put you at risk. Real planning, coordinated with your wealth and your business plan. Schedule a call with our team. The link is in the show notes. The first conversation is free. If nothing else, you'll get a clean read on whether or not you're currently doing what you need to be doing. So here's my take. I've seen real examples of these strategies going wrong, I will tell you. And it is not fun. And the IRS is getting better at this. They're using AI just like you are. And they're using AI to detect patterns and to find these instances more effectively. Don't get me wrong, I understand the temptation. The tax pain is real. I feel it myself. I'm a business owner too. When somebody tells you they can make it go away, it sounds very good. But the math on these schemes only works if you don't get caught. And we really don't want to be in that position to begin with. One last thing. Tax planning doesn't live in a silo. It touches your business. It touches your personal financial plan. It touches your estate plan. And the bigger your firm gets, the bigger your income gets, the more important it is that the people advising you are actually talking to each other, are coordinating, are double-checking their work, and are not making mistakes. That's a problem that we solve here at The Lawyer Millionaire. We give you a full business, tax, and wealth team under one roof. Your team includes a CPA, a certified financial planner, and a business advisor. Everyone on the same page. And me. Everyone looking at the big picture. So, you don't end up with a tax strategy that wrecks your estate plan or an investment portfolio that doesn't pair well with your tax situation, or a CPA who's never talked to or met your financial advisor and is going to miss your 1099. If you're at a stage where complexity is starting to creep up, that's exactly when this matters. Head to lawyermillionaire.com/strategy to schedule your call. We'll figure out where you are, where you want to go, and whether what you're doing right now is going to get you there. Well, that's it for today, friend. And remember, if your law firm isn't building you wealth and freedom, what the hell are you doing? Can I get an amen? I'll see you next time.
Are you a law firm owner looking to build real wealth and break free from the daily grind? On the Lawyer Millionaire podcast, we share practical strategies to grow your practice, maximize profits, and create the financial freedom you deserve. Join host Darren Wars as he interviews top experts and successful law firm leaders who share their secrets. Don't just practice law, build a legacy. Listen now to The Lawyer Millionaire wherever you get your podcast. The Lawyer Millionaire podcast is for informational and educational purposes only. It is not intended as legal, tax, or investment advice. Listeners should consult with a qualified professional before making any financial or business decisions. The views expressed by guests are their own and do not necessarily reflect those of Darren Wars or Lawyer Millionaire Wealth Advisors.